In what's being called the Great Wealth Transfer, millennials who got off to a slow start are now expected to become the richest generation in history, thanks to the nearly $124 trillion in assets that they're expected to inherit over the next 20 years from their baby boomer parents and grandparents. In The Missing Billionaires by Hagani and White, they tell the story of Cornelius Vanderbilt, who died in 1877, leaving his oldest son the largest fortune in the world at the time, more than $100 million. Despite the huge returns available to investors between then and now, just 70 years later, the entire Vanderbilt family wealth was gone. No Vanderbilt descendant today can trace their wealth back to the huge fortune Cornelius accumulated during his life. The huge spending and bad investment decisions of the Vanderbilt heirs wiped out the entire fortune. It brings to mind the famous W.C. Fields quote where he said, "I spent half of my money on gambling, alcohol, and wild women. The other half I wasted." When we look at a list of the wealthiest Americans today, the top 10 all made their money through business, not from inheritance. It's not until we get to number 11 on the list that we see the Walton family, the heirs to the Walmart fortune. According to UBS, 84 people became billionaires for the first time in 2023 through the businesses they built up, and 53 became billionaires through inheritance. So business success is still the most sure path to wealth. Inheritance, however, has become a more important source of wealth in recent years than it was 50 years ago, but it's still less important today than it was in 1900. Research from The Economist shows that inheritance as a source of wealth in advanced economies, when measured as a percentage of GDP, has roughly doubled since the mid-20th century, but it's still around half what it was in 1900. There are a number of factors that have driven this change, such as the size of the aging baby boomer generation, the unusual level of economic success that they've had over their lives, and the rise in real estate prices, which began growing faster than inflation in the 1960s. The Economist points out that governments publish very little data on the size of inheritances, so they did their own research on annual inheritance flows for a range of countries. They found that in advanced economies, inheritances were worth over 20% of GDP in 1900, as people passed on vast stock portfolios and estates. The value of inheritances collapsed in the wake of two world wars, hitting a low of around 5% of GDP in the United States by the late 1970s, before bouncing back. By the end of the 2010s, inheritances were worth, on average, 10% of GDP. This year, according to their calculations, people across the rich world will inherit around $6 trillion. Inheritances collapsed after the two world wars, as a lot of wealth was tied up in European real estate, which was destroyed during the wars. High inflation afterwards eroded the value of cash and government bonds. Waves of nationalization and wealth taxes wiped out wealth too. One of the more interesting things that The Economist found in their research was that inheritances relative to national income grow much faster in slow-growing countries than they do in high-growth countries. They found that in the fastest-growing countries like the United States and Ireland, the ratio of inheritances to national income grew the least, while the ratio grew the fastest in Italy, where the economy abruptly stopped growing in the mid-1990s. In fact, looking at the chart, Italian inheritance flows relative to national income took off right as the economy stagnated, rising from around 7% of national income in 1990 to around 19% by 2023 when their data ends. According to their research, 60% of today's Italian billionaires inherited their wealth. A 2014 paper by Kaplan and Rao shows the opposite has happened in the United States, where the percentage of Americans in the Forbes 400 who came from wealthy families declined significantly since the 1980s. According to that paper, there are fewer people on the Forbes 400 list who took over family businesses, and there are more self-made business people like Bill Gates, Warren Buffett, Philip Knight, and Stephen Schwarzman, who had an upper middle class upbringing and eventually built their own successful companies. As a share of output, annual inheritance flows have doubled in France since the 1960s and nearly tripled in Germany since the 1970s. Before looking at why stagnant economies can become inheritocracies, let me tell you about today's video sponsor, Surfshark. Surfshark has been my VPN of choice for quite some time now. It's an easy-to-use and affordable VPN app for Windows, Mac, Android, iOS, and more. VPN stands for Virtual Private Network, and when all of your internet traffic goes through a secure encrypted tunnel, adding a layer of privacy protection, which is particularly important if you use public networks at coffee shops or airports. Surfshark improves your privacy, makes it harder to be tracked online, and can bypass internet censorship. Surfshark doesn't just protect your data. You'll also find that if you log into streaming services from different countries, different content is available. With Surfshark, no matter where in the world you are, you get to take the internet from home with you. Surfshark is fast, reliable, and they don't collect or track your data. The best part is that Surfshark doesn't just protect you, but your whole family too, as they allow unlimited devices to use the one account. There's no risk in trying Surfshark as they offer a 30-day money-back guarantee. Go to surfshark.com/Boyle to get 4 extra months of Surfshark VPN. Click the link in the description to sign up today. There are a few things likely driving the dynamic where inheritance has grown in importance relative to earned income in low-growth economies. Firstly, in a place where the pace of economic growth has slowed, wage growth will have slowed too, as will business profitability for the self-employed. When incomes are no longer growing, inheritances will start to matter a lot more, and older people who earned their money when the economy was more vibrant will have built up greater savings than can be accumulated in the new slow-growth economy. Secondly, when economies stagnate, central banks often respond by cutting interest rates to revive growth. Lower interest rates inflate asset prices like real estate and stocks. So those who already have savings invested will see better returns in such an environment. It's hard to know how young people who are about to receive these large inheritances will spend them. Merrill Lynch points out that young investors are more skeptical of traditional investments and are more open to new financial products like crypto, private equity, and direct investment in companies. They say that young investors are attracted to the idea of founding their own companies or brands too. According to their research, 82% of investors between the ages of 21 and 43 consider a company's environmental, social, and governance record, while only 35% of investors 44 and older take that into account. Wealth passing from the older generation to the younger generation could mean that money is invested quite differently over time. One of the worries about businesses being passed on from founders to their children or grandchildren is that these transfers of wealth could slow overall economic growth. The heirs to family fortunes become wealthy through inheritance rather than through their own efforts, and these non-merit-based wealth transfers could reduce economic vibrancy, as capital is no longer in the hands of risk-takers and innovators. The story of Vanderbilt's wealth being squandered, or Boot Tarkington's book, The Magnificent Ambersons, warns of how wealthy heirs may mismanage their inheritance, which doesn't just erode their own wealth, but can strip opportunity from the employees of the great firms that they inherited. The Magnificent Ambersons tells the story of a wealthy Midwestern family whose fortune declines over 3 generations during a period of rapid industrialization. The decline of the Amberson family fortune is contrasted in the book with the growth of the town and the other families who are busy building wealth through hard work. The book warns that if future generations are wasteful and don't keep up with technological changes, that inherited wealth can gradually waste away over time. Declining birth rates, which we've discussed in the past on this channel, are also affecting inheritances. People with fewer children find it easier to accumulate wealth, as children are both expensive to raise and consume a lot of parents' time. Parents with fewer children can accumulate more wealth. On top of this, heirs with fewer siblings can expect to, on average, inherit more, as there are fewer children to divide the inheritance between. This doesn't affect the ratio of inheritance to national income, but it does mean that young people who do inherit can expect their inheritance to be larger than inheritances would have been in the past when they were divided between more children. Using British data, The Economist estimates that falling birth rates have raised the amount going to the average heir by around $75,000, which is 24% higher than in the past. While there's been a lot of press about millennials being angry that the boomer generation were able to buy houses at a much younger age than millennials could, millennials who are now in their 40s have caught up on Generation X. The asset management firm Vanguard recently projected that over $18 trillion in wealth will be handed down globally by 2030 in the largest intergenerational transfer of assets in history, with much of it being transferred from boomers to millennials. A breakdown of the type of assets owned by the different generations in the United States from the FT shows the huge amounts of real estate and equities owned by the boomer generation, which will pass to younger generations in the coming years. We've talked about the differences between self-made billionaires and those who inherited billions, but most heirs are not inheriting vast fortunes or anything like that. Most will be inheriting a family home or a cut of the proceeds from its sale. One of the main reasons that inheritances have gotten so big in recent decades is that home prices have gone up so much. On top of that, the generation that benefited the most from real estate ownership, the baby boomers, is a really large cohort, and soon they will be passing it on to their children and grandchildren. There are stories of taxi drivers or maids who bought what were once affordable homes in cities like New York, San Francisco, or London many years ago, which are today worth a fortune. This boom in asset values means that not only are inheritances larger, but also that they're now worth fighting over too. According to the FT, more than double the number of probate disputes were brought before the High Court in 2023 than occurred in 2016. Having wealthy parents or grandparents is, of course, not the only way to get rich. As the older generation has gotten wealthier and wealthier, some ambitious young people, instead of focusing on climbing the corporate ladder, have gotten rich through predatory marriage, which the FT reports has grown hugely since the pandemic. You do have to time this sort of thing well, though, keeping in mind that people are living longer than ever before. In the United States, the average inheritance has quadrupled since 1995. Back then, of the people who received an inheritance, the average inheritance was $100,000. Today, it's close to $400,000. In Britain, 1 in 6 of those born in the 1960s can expect to receive an inheritance that exceeds 10 years of average annual earnings for their generation. For those born in the 1980s, the ratio rises to 1 in 3. In the United States, baby boomers own 37% of the housing stock, while making up around 20% of the population. They own 57% of the vacation homes and 58% of America's rental properties. Boomers own private companies too, including 41% of U.S. small businesses, which are collectively worth almost $8 trillion. Many are not planning on passing their businesses down to their kids and are instead selling their businesses so that they have spending money for their retirement and so that they can give cash to the next generation, allowing them to pursue their own dreams rather than forcing them to run the family business. Many parents and grandparents are not waiting until they pass before transferring wealth to the younger generation. They're helping their children and grandchildren out with down payments for houses, paying for private school tuition, and helping out with expenses like student loans. According to research from Legal and General, if the bank of mum and dad was an actual bank, it would be one of the 10 biggest mortgage lenders in the United States. As great as this is for young people from wealthy families, others have no wealthy relatives to borrow from and stand to inherit nothing in the coming years. Federal Reserve data shows that the top 1% of recipients in the United States will receive 50% of the overall wealth transfers, and that 60% of Americans will inherit less than $5,000. Many argue that inheritances only make inequality worse, and that they should be reduced by a redistributive inheritance tax. But in the United States and in most of the rest of the world, inheritance taxes are amongst the most hated forms of taxation. Surveys show that people hate inheritance taxes as they believe that parents should be able to support their children by passing on their savings, because they feel that inheritance tax is a tax on income which has already been taxed. They also worry that an inheritance tax might cause the wealthy to move abroad, and they worry that an inheritance tax encourages consumption above investment. UK surveys show that voters find inheritance taxes unfair and believe they should be reduced or abolished. Surprisingly, opposition to inheritance and estate taxes is even stronger among the poor than the rich. Milton Friedman discussed this topic many years ago on his Free to Choose TV show. He argued that from an economist's point of view, it's surprising how parents who know that their children are likely to be wealthier than they are still want to save money so that they can pass something on to the next generation, and that parents appear to value their children's consumption above their own. Not all boomers plan on passing their wealth on to their kids. Bill Gates has said that he intends to pass on less than 1% of his wealth to his children, and he told the FT this week that he plans to spend his entire fortune over the next 20 years on global health development and education. Brian Johnson, the anti-aging influencer, says that he expects to live forever, so he'll likely need all of his money to spend on things like hair dye and embarrassing his son. Even the boomers who are spending all their money and plan on passing nothing on to their kids will still be transferring wealth to younger generations who sell them the goods and services they are consuming. Many boomers are uncomfortable with the idea of passing wealth to their children while they're still alive, even if their kids have a greater need for money today than they will in the future. Many boomers feel this way because they didn't get handouts from their parents or inherit large sums of money either. As Ben Carlson points out on his blog, baby boomers were brought up by parents who lived through the Great Depression, didn't accumulate much wealth, often died in their 60s or 70s, and drilled a mindset of scarcity into their boomer kids. While the boomers became big spenders later in life, having received no big handouts from their own parents while they were still alive, and only getting an inheritance when their parents passed away, many boomers feel that that's just how things should work. Carlson points out that millennials spend way more money than baby boomers did at the same age, driving nicer cars and desiring bigger, more opulent homes. They travel more than their parents did, spend more on technology, and are more willing to pay up for convenience. He says that millennials spend more on their own kids than boomers did and don't understand why their parents seem reluctant to help them out. He argues that intergenerational conflict can be reduced if families talk about money more often. Adult kids often believe that their parents are wealthier than they actually are, and the older generation often don't understand the pressures that their adult kids are facing. The biggest driver of the inheritance boom is the boom in global housing prices, which is partially driven by restrictive planning policies in most of the developed world. These policies have restricted supply, pushing ordinary home prices higher, such that they're out of reach to many young people. The value of buildings owned by Britons has risen from just over £1 trillion, which was 130% of GDP in the mid-1990s, to just under £7 trillion, which is 270% of British GDP today. As housing has become more and more expensive, in particular in big cities, a 90th percentile income no longer pays for a 90th percentile lifestyle. Had the housing stock grown in line with population growth, people would still be inheriting homes from their parents and grandparents, but it wouldn't be such a big deal. The houses they would be inheriting would be the exact same ones, but the price tags attached to those houses would be much more modest. A 20-year research project by the Williams Group, covering 3,200 families, found that 70% of wealthy families lose their wealth by the second generation and 90% by the third. Wealth can get wiped out in family squabbles and lawsuits, or young beneficiaries can lose everything in foolish investments. This can be a bigger issue when the inheritances are larger and made up of cash, securities, or business ownership. It's a little bit more unusual for an heir to lose a family home which they inherited. According to research by Charles Schwab, young adults might have unrealistic expectations about their future finances. Their research shows that young adults expect to retire younger than their parents, but save less for retirements than their parents did. And only 40% of young adults, according to their research, can pass a basic financial literacy test. 53% of young adults, according to the same survey, expect an inheritance from their parents, when only 21% of people ever receive one. If you found this video interesting, you should watch this one next. Don't forget to check out our sponsor, Surfshark, using the link in the video description. Have a great day and talk to you in the next video. Bye.